Hey, Peter here from How to Invest HQ, and today we're going to discuss how to invest $2,500 into the stock market. And we're going to look at different time frames for how long you want to put your money into the market for, and what sort of investments you should make based on the amount of time you have before you want to take that money out. Why $2,500? $2,500 is the perfect sum to start investing in the stock market. And I think that this is the minimum sum necessary for investing in individual stocks without losing too much money to trading fees. Trading fees are typically $8 to $10, and you have to pay that $8 to $10 for every stock that you buy. And you have to pay that same amount of money when you sell the stock. So if you buy 5 stocks at $10 fee per share, and you put about $500 into each stock, you'd actually only have $2,450 after fees. You'd spend 2% of your total investment on trading fees, and you'd have to spend that same $50 when you sell the stock. And time matters, and the amount of time you have for the money depends on which methods we're going to use for investing your money. If you have less than a year, I'd recommend avoiding the stock market altogether. One, you're gonna have to get very lucky to actually beat your trading fees. If you're spending 2% to buy and 2% to sell, and the market only returns 10% a year, there's only a 6% range for you after fees. And there's also a chance you could lose. There's no guarantee you're going to make that 6%, in that year. You might lose money and then lose money on the trading fees. A year is not a very long time, and less than a year is really not a long time. And then you have to consider that even if you did market average and got a 10% return on your $2,500, that's only $250, and that's before trading fees and before taxes on your profits. You do have to pay tax on stock market gains, and that's just not a good return. Why take all the time to research your stocks, buy your stocks, follow the stock market, and sell them to make about $100? That's a waste of time. The safe approach would be to buy a CD or a bond, but current short-term rates are less than 2%. You might make $30 at the end of a year. Again, not really worth your time. So if you have less than a year to invest and you only have $2,500 and you want to spend that $2,500 in a year, you might as well not bother. Just put it in a savings account and get it in the 10 months you need it. It's not worth setting up a CD or buying into the stock market when you have such a little time to invest. If you want to go 1 to 5 years, though, suddenly we have a little bit more room. 1 year or less, probably wouldn't even recommend doing this, but if you have like 18 months and above, this starts to get worth it. And this is what we do is we pick 4 to 5 blue chip or newly paying dividend stocks. I recommend the following 15. Johnson & Johnson, Procter & Gamble, Starbucks, Pepsi, Bristol-Myers Squibb, Apple, Disney, AT&T, General Electric, Home Depot, Wells Fargo & Company, Pfizer, JP Morgan Chase, Nike, and Visa. Pick 4 or 5 of those stocks, split your money as evenly as possible between them, and enroll those stocks in a dividend reinvestment program. That's, what I would recommend doing. And over 1 to 5 years, especially if you can hold it for 5 years, you should start to make some pretty good money, as the dividends these stocks pay out are used to purchase new shares of stock. And those new shares of stock will pay out a dividend, which can then be, again, rolled into the stock to get more shares. So at the end of 5 years, you'll end up with, 10 or 20% more shares than you started with, plus whatever the shares increase with in value. If you have more than 5 years, you could do the same 4 to 5 solid blue chip stocks or new dividend paying stocks as discussed before. If you want to take a little bit more risk for possibility of a little bit more gain, I would consider investing in a growth stock that is both best in class and in a growing market. My recommendations would be Zillow, LinkedIn, Yelp, Google, Chipotle, and Amazon. The ones that are starred I actually already own shares of. I'm not going to recommend a stock and not buy it because I think that these are good investments, so I want to make money too. So I am investing in a lot of these stocks. I'm not making this video in an attempt to pump these stocks because, frankly, these are many multi-billion-dollar companies, all of these, and I just don't have the kind of reach that would allow these stocks to move up in value from anything I say. But, I'm going to hold these for a couple years as the plan and just let it go, see what happens. And here's sort of, why you need a lot of time, and here's an example of what you can expect. So here's this is about a 10-year term or 11-year term And in the second column here, we have a 2.6% bond. The U.S. Treasury notes right now are 2.6% for a 10-year term. If we did $2,510, we picked $10 so we could have an even number of shares of Johnson & Johnson for this example over here. Your $2,510 would turn into $3,250. So you'd make about $750 or $740 in 10 years. Better than nothing, but this is really about inflation values. $2,500 would buy you about as much gas today as it did back then. Same thing with milk and bread and what have you. So it's really not that compelling of an investment. You really don't want to tie up $2,500 to make for 10 years to make $750. To me, not worth it. So here's the S&P 500, and I use this as a calculator to estimate if you put in on June 1st, 2014, $2,510 and reinvested your dividends as of May of this year, you'd have $5,100. This is 2014. I don't have the individual data just because the calculator didn't apply. So here, if you're getting this average, 9 or 10% or 11%, depending on the year you invested, you'd actually double your money. And you would have to pay taxes on this and a little bit on the dividends along the way, but you'd have to pay taxes on the bond return too. But you could double your money in just about 11 years if you would have put it in the S&P 500. That's a much better gain, and that does beat interest. $5,000 today is better than $2,500 in 2004. A new car back then might cost you $15,000, and today it costs $20,000. It's not double. So Johnson & Johnson, here's an example of one of the dividend stocks, and this I actually have it broken down by year just because their calculator actually gave this data out. It's pretty convenient. So if you put $2,500 or in 10 just for that extra share into Johnson & Johnson in June 1st of 2004, here's what it would look like on a year-by-year basis. So this is why time matters so much. So after 1 year in Johnson & Johnson here, Johnson did really well this year, $500 gain. And that's worth it to me. And you'd only pay a $10 fee buying one stock. $2,500 to $3,000, yeah, it's worth taking the hour to set up an account for $500. Most people don't make $500 an hour. But, however, when you only have a year to invest, you could have bought in on 2005 and then lost money. Or even worse, bought in 2008 before the crash and then really lost money in 2009. You really need to hold for a long period of time to start to see the gains. And as a result, Johnson & Johnson is fairly flat. But even what's great about dividend stocks is they pay you a dividend, which you can use to buy more shares of stock, and then those shares start to pay you a dividend, which can be used to buy more stock, and that continues every year. So even though the market crashed so much in 2009, because we've been in this dividend reinvestment program, we actually have a positive result. And shares at this time were actually a little bit higher than they were at this time. But in this year, we had more shares from the dividend reinvestment program. So now we're still in the positive. And then once the market turned around, especially from 2012 until today, this investment's almost doubled in value. So this is why I like dividend reinvestment program, especially for long term. It really starts to pay off. If you invest in a good blue chip stock, you tend to beat the S&P 500 by a little bit without much more risk. You don't want to just buy one company. It's best to buy about 5 just in case one, goes through a tough time and you don't get, destroyed by that one stock. Here's an example of the growth stock. And I picked Google. Obviously, in hindsight's 2020. So take this with a grain of salt. For every Google, there's another company that goes out of business. They're just crummy. But if you put that same $2,500 in Google when they first went public, today that would be worth, $23,000. So growth stocks definitely have far more potential than your standard investing, but they also have risk. And you need the 5-year period to make sure to really minimize the impact of the risk of these stocks. So that's it for the presentation. Hope you found this helpful. Go ahead and subscribe to my channel or follow my blog for more stock investing strategies.